Hello and welcome. Thanks for joining our virtual coffee talk webinar. Before we get started today, I'm just going to go over some housekeeping items regarding CPE. Kevin, can you switch it to the next screen? All right, there we go. So you can earn 1 CPE credit by attending today's webinar. In order to receive the certificate, you must participate and respond to at least 3 of our interactive questions. We also ask, it's not required, but we ask that you fill out our course evaluation that will pop up at the end of the webinar to give us some feedback. Also to let you know that you will receive an email in about 2 to 4 business days with instructions on how to access your CPE certificate. I also wanted to note, because it's been, just a couple issues with making sure that you realize that the certificate will be sent to the email address that you registered with. So be on the lookout in that email account. And with that, I will go ahead and pass it over to Kevin.
Great, thank you. And thanks everyone for taking the time today to talk to us. We're really excited about the topic and discussing executive compensation and qualified plan hot topics. Obviously, there's a lot of eyes on what's going on in Congress right now with tax reform. We'll touch a little bit on that during the presentation. But really, we thought that we wanted to make sure that with all the attention going on to what is happening in tax reform, what will and won't be included, we're not also missing some of these other hot topics that people should be paying attention to, while also letting you know what we're observing from the IRS and from DOL audits. And so as you can see on this agenda, we're going to first start talking about section 162M, the updates, potential changes that have been discussed, mergers and acquisitions, and section 280G, golden parachutes is a hot topic. ESG is definitely something that we've seen not in the comp and benefits qualified plan area, as well as in mergers and acquisitions. We're seeing more and more companies focusing on ESG and their metrics. And that really has a broad range application as far as deal activity, as well as the compensation. And then we'll turn to the employee plan compliance resolution system, and finally end with IRS and DOL audit focuses. I'm really excited this month. I'm joined by 2 of my colleagues. Patrick Blanchard and Allison Hoinghouse are joining me from the comps and benefits groups of Alvarez and Marcel Taxand. And so they're really going to be able to provide the updates of what they're seeing. So with that, Allison, if you want to take us to 162M.
Great. Thank you so much, Kevin. So today we wanted to kick off with section 162M, or the $1 million deduction limitation for compensation. And we've had some changes in this area this year, and there's actually some more in the pipeline as well. But before getting into some of the changes, I wanted to first just kind of step back and give a quick summary of where the law stands today. So generally under 162M, no deduction is allowed to any publicly held corporation for what's referred to as applicable employee remuneration in excess of $1 million for a tax year that is paid to any covered employee. So we break that down here a little bit, starting with covered employee. Who exactly is subject to these rules? So this deduction limitation is going to apply to the CEO, the CFO, and anyone who's acted in that role during the year. And then it's also going to apply to the next 3 highest paid officers other than the CEO or CFO or somebody that held that role. Now, we actually had quite a few changes to 162M back in 2017 as part of the tax reform legislation at that time. And one of the biggest changes, there were several, but one of them was that once an individual was considered a covered employee for any year, they're always going to be a covered employee now. So that's a pretty big change. Before it was just kind of every year you made this analysis and determined your covered employees. But now, once you've been deemed one, you're one forever. The other couple of big changes that happened back in 2017 was it expanded who is considered a publicly held corporation. Before, it was pretty much just anyone who had publicly traded securities, but now it also applies to companies that have publicly traded debt as well. So that's an expansion. And then probably one of the biggest pain points back from the changes in 2017 was it repealed the performance-based exception as well as the IPO transition rule. So the performance-based compensation exception was a big deal. It was a way before that certain compensation, if it met certain requirements, would not count against that $1 million limitation. So that put a lot more pain in these calculations for companies. So that was 2017, and fast forward to this year, I feel like we were just now kind of getting where we were settled with the new 162N, right? Kind of got into our groove with this, and then in March of this year, the American Rescue Plan Act of 2021, or ARPA, expanded the coverage of 162M once again. And the big changes there that happened in March were it expanded to cover 5 additional employees under 162M, other than the 5 that were already covered. And one key thing here is that 5 additional employees. The original, or what was in place, changed in 2017, that was only covered officers. This new provision applies to employees, so it doesn't have to be somebody that actually has the roles and authorities of an officer. It could be somebody who's just a very high-paid individual within the organization. But there is one difference here, is that if you are one of those 5 employees after the top 5, you are not going to be considered a covered employee for forever after that. It is just that year, and it can change every year. So this 5 people will probably be rotating for companies over the years. So it is good that they won't always then be subject to these rules from here on out. Now, these changes, again, they were made in the spring. They were set to go in effect in 2027. That's when they're scheduled to start. So the rules were giving taxpayers basically 5 years to get prepared for this change and figure out how they were going to track these additional employees and their various compensation at the entity. But as things always do, we've got some more changes that are possible here in the near future. So as part of the infrastructure bill that is being heavily negotiated and changing, every 2 seconds, one of the proposals to actually fund part of that bill under the House Ways and Means proposal is to actually accelerate these changes that ARPA had made from 2027 all the way to 2022. So they're proposing for this to go into effect in here just a couple of months. So it would significantly shorten the amount of time that companies have to really get prepared for this. The House Ways and Means proposal also makes a few other changes. In particular, it makes some kind of technical corrections or clarifications about how the rules actually work. And a lot of them are really geared at workarounds that, companies might try to utilize to, mitigate the impact of this loss deduction. One example is it specifically includes now post-termination compensation in the definition of applicable employee remuneration. It also clarifies in that same definition that compensation for services to a publicly held company is going to apply even if that company wasn't who directly paid those amounts as well. And then it's also adding another layer of complexity by adding the Section 414 aggregation rule, so that compensation paid by different members within a control group would need to be aggregated for purposes of determining whether that $1 million limit has been crossed or not. And so that's going to definitely add some complexity there, but will also make it where, it's not like 2 different entities having different limitations. It's going to make it more strict and harder to comply with. So with that, I want to pause and ask Kevin, what is the latest that you're really hearing on the probability of this change in particular making it into whatever final legislation occurs here?
Yeah, so this is where it's been a lot of fun the past month following what's going on in DC. And, the most recent update, as I'm sure uh, the participants on this webinar have seen, is President Biden has announced and the White House has released a framework for which they're hoping the Democrats will rally around. That framework contains a host of tax changes, including corporate minimum taxes and international changes, but this was not mentioned in the list of things. Now, just to note, it's a framework. It's not necessarily the only provisions that will be included, but as of right now, there hasn't been much discussion regarding the 162M changes, as well as a host of other changes that we've been discussing for the past several months. So really, it's a wait and see approach, but right now it seems like it might not be there. But with that said, obviously the acceleration of the ARPA expansion is really going to be a revenue raiser. So if they need to get a little bit over the hump, it's possible that they sneak that in, saying, okay, well, we want to make sure that it's really fully funded, which is something the Democrats have been saying. And so they could just say, okay, we have this number out there. It's a plug and play to make sure that we fill it. But again, most of the focus has generally been on the expenditures rather than the revenue. And this isn't a big enough item really to say, okay, it should have, if it was going to be included, it would have been mentioned in the framework. And the fact that it wasn't in the framework, it's definitely not going to be there. So really it's a wait and see, but there hasn't been much discussion on it.
Well, that's helpful. And alluded to earlier, it's obviously changing all the time. So we'll see what ultimately occurs here. But something that is going to go, certain versions of this, it is going to go in effect in 2027 if it's not accelerated. So still something to be mindful of. And I think that takes us to our first polling question.
Great.
So our first,
yeah.
You were good, Jake, I think? Go for it.
Yeah, I was going to say this is sort of a preview of the next topic that we'll be talking about. And so again, as mentioned, just for CPE purposes, please make sure that you've answered the question. I promise there's no right or wrong answers. But here we're just inquiring if your company's been involved in a merger or acquisition, either as the target or the acquirer within the past 12 months. Yes, no, not applicable. So if you're advisor, obviously it wouldn't be applicable. If you're at the company, you could say yes or no. Again, please make sure that you answer this question so that way you can get the CPE credit. But with that, Allison, while they're starting to answer this question, do you want to go into Section 280G, introduce it, and
Absolutely. So this next topic is not new per se, but it's something that we've seen quite a bit of renewed attention and kind of news around, and it's due to the really hot mergers and acquisition environment that's going on right now. And I think no surprise to anyone here, but the global mergers and acquisition environment, it hit a record in Q3 of this year by surpassing $4.3 trillion in deal activity in the first 9 months of this year. And if the market keeps on this pace, it could hit close to $6 trillion by the end of the year. So there is a lot of M&A activity going on globally, and in particular in the United States as well. So one of the biggest items that gets a lot of attention and scrutiny in the compensation space around M&A is the golden parachute rules under Section 280G. So wanted to give just a quick overview of 280G and the mechanics and how it works, but to really pivot to what are we seeing today in terms of actual deals. And if you get into a 280G situation where you have an issue, what are maybe some of the planning alternatives that you should consider? So first, quickly here, you can see on this slide, we've got a little diagram to try to illustrate how 280G works. But essentially, golden parachutes are going to be payments and different types of benefits that are received by employees in connection with a change of control, or perhaps it's their termination in connection with a change of control. So it usually impacts your top executives and upper management. And if the individuals receive benefits that are deemed too big, the company is going to lose a corporate tax deduction, and the individual is going to owe a 20% excise tax on what's deemed excess parachute payments, or the amount that's too big. So how do you define what is too big in this situation? It is by individual, and you start with an individual's 5-year average Form W-2 compensation, box 1. So that's this first little blue box here on the left. And 280G says, nope, that's too much money once you cross 3 times that base amount, or what we refer to as the 280G threshold. So that top red dotted line on the slide. So if you add up all the different types of benefits that the individual receives, things like severance, equity, health and welfare benefits, if you cross that top red line, then you have tripped 280G. But what's so difficult about 280G is it's not just in this example that little green sliver that's over the top red line that you have the tax consequences on. It actually goes all the way back down to that one-time base amount, or just the one blue box there. That's what the individual is going to owe the 20% excise tax on, and that's what the company loses the deduction on. So it's very punitive, the way the mechanics work for 280G. Now, historically, it used to be really common, you see the dotted boxes at the top, for companies to provide excise tax gross up that would keep the executives whole for this excise tax. Now, they still have to pay their normal taxes, of course, but it would make them whole from this 20% excise tax. But as you can imagine, that got very expensive very quickly for companies, and it definitely fell out of favor. Institutional or shareholder advisory firms like ISS and Glass Lewis, they hate gross ups, and so over the last 5-10 years, we've seen the prevalence of them really drop. It is now a very small minority practice, and really it's just, there's a few companies that still have grandfathered gross ups, but really not seeing new ones implemented in agreements or plans anymore. And so I mentioned that just because it shows why, when you get into a real transaction, why there's so much focus on the planning alternatives here, because it really can be quite costly for executives, and they no longer have this protection that used to be pretty common. All right, next slide. We're now going to shift to what are we seeing today in the market? What are the latest trends around change of control benefits? And every other year, Alvarez & Marsal partners with Equilar to conduct a change of control survey to evaluate what is market around CIC benefits. So it covers the 200 largest companies across 10 different industries, so we can really evaluate what are the differences in different industries. So this is going to actually be released in a couple of weeks in mid-November, but today I wanted to give everybody just a sneak peek of some of the findings so we can really evaluate where is the market today. And if anybody wants the full survey, just shoot us an email. We're happy to share it when it's released, and it's also just going to be out there for anybody to Google and just get the data, because it is a very helpful tool for a lot of companies, again, because it does show industry differences as well. So this slide gives just kind of sets the scene in terms of change of control benefits. So first, here on the left, what we found since we last did the survey in 2019 is that the values for CEOs increased dramatically. They're now almost up to $40 million, which is over a 40% increase from in 2019. And then the second set of boxes, it looks like maybe the titles got lost there, but the second set of boxes is actually representing the CFOs. And we saw a similar increase, not quite as large as for CEOs, but a 24% increase up to over $12 million for the CFOs. Now, you can tell these are very big numbers. They are eye-popping, and so they get a lot of attention pretty quickly when a deal is on the table. But it is important, and we'll talk about why in a little bit, but these benefits, even though they are very large dollars, they tend to be still a pretty small percentage of overall deal value. So you can see here that the benefits for CEOs and CFOs as a percent of the market capitalization is only 0.05%. So still small relative to the size of these deals, but because it's big numbers going to individuals, it gets quite a bit of scrutiny. Now, the other thing to highlight here is not all industries are created equal. We definitely see differences, as this circle graphic on the right shows. Telecommunications and information technology by far have some of the largest benefits that they pay out to executives. Conversely, consumer staples is one that's kind of on the lower end in terms of the benefits being provided. So with that, we could shift to the next slide. And what I wanted to just highlight here is two of the most common benefits that are provided to executives in connection with a change of control. And starting with severance, so it's very common for both CEOs and CFOs to be contractually entitled to severance in connection with a change of control if they do lose their job. So over 80% of both CEOs and CFOs. Now, absent a change of control, if an individual is just involuntarily terminated, not quite as prevalent, but still very prevalent in the mid-60s for CEOs and CFOs. And I think the reason we see maybe a little bit less for absent a change of control is just because some companies choose to just individually negotiate that at the time of termination, just based on the specific facts and circumstances with that individual. Now, how is severance typically defined? It's usually going to be some sort of multiple of the sum of base salary and bonus for that individual. And the chart here on the left shows what are the common multiples specifically for CEOs. And by far, the most common was between 2 and 2.99 times the individual's compensation. So 48% of companies there. But then 3 times compensation was actually the next prevalent, with 33% of CEOs receiving a 3 multiple. So you could do the math and realize this adds up pretty quickly in terms of the dollar amounts for these individuals. But it actually pales in comparison to the second component that we want to talk about, which is long-term incentives. You can see here on the chart on the right, since we did the survey in 2019, long-term incentives were about 2/3 of the benefits received by executives. This year we found it was 75% of the CIC amounts for CEOs and CFOs were actually comprised of these long-term incentives or equity awards. So this isn't really too surprising, though, because if we step back and think about what the market's done over the last 12 months, for most industries, it's been pretty hot and on the climb. And so as the stock market does better, obviously, as we are paying executives in stocks, they're receiving additional value when the prices increase. But I also think it's also another factor over the last 5 or 10 years or so, where there has been increased focus and allocation to paying executives more heavily in incentive compensation, and in particular equity, to help with the pay for performance alignment, to be sure that they're tied with shareholders doing well at the same time. So I think that's also part of why we've seen such a large shift there in terms of the percentage that is comprised of equity awards. All right, with that, we'll head to the next slide here. And this is really where I wanted to spend some time just talking about, we see a lot of executives getting very surprised by their tax bill when there's a real deal on the table. And so immediately shift to what can we do about this. And one of the things I want to highlight is kind of something that's been something that seems like we've seen on an increasing basis over the last year or two, is the concept of an 11th hour gross up. Now, I mentioned earlier that those are basically non-existent. There's only a couple out there in existing plans and agreements, and that's absolutely true. But we've seen where when a company doesn't have a gross up, sometimes they're going in and negotiating as part of the merger agreement at the time a deal is actually happening to then add a gross up at that point. And it's not always totally clear that that's what's going on. A lot of times it might be referred to as a deal bonus or a transaction bonus or something like that, but the way they're actually coming up with who gets what dollar amount is really around how people are going to be impacted under Section 280G. So that's something just to keep in mind. It's something we definitely see more prevalent in certain industries like pharmaceuticals and other industries as well. And I would say it's still very much a minority practice, but we are seeing it seems, increasingly as people are, realizing how expensive this can be. And if the company is done really well and this is, a really good merger or acquisition, then we are seeing some success with companies negotiating in that payment. But let's say you don't have a gross up, either existing or you negotiate one in at the deal time. What are some other things that you could do to help with the consequences under 280G? The first one is something that we get a lot of questions about, especially this time of year, and that's base amount planning. So the simple concept here is just that little blue box that determines whether you actually trip 280G. We look for things that will make that blue box as big as possible. So things like exercising stock options, accelerating bonus or stock awards into the year, anything to make that blue box bigger. As you can tell, though, this only works if you know about it the year prior to a transaction occurring, though, because we can't, obviously, it won't be included in the base amount if you're in the year of the change of control. So the couple of warnings here, though, is that anytime you start talking about accelerating payments, always got to just say, watch out for 409A in these situations, the deferred compensation rules. When you start accelerating payments, you can run afoul of those rules if you're not careful. And then the situation there would be just swapping a 20% excise tax for then the additional 20% tax under 409A. So want to be really careful with that don't cause any unintended consequences there. But the base amount planning can be really helpful and can get individuals out of the 280G implications. In particular, you get a lot of bang for your buck if you can get that top red line high enough where somebody just doesn't have an issue. Now, if somebody's still going to have an issue, this isn't quite as lucrative. It's still very a helpful thing to look at. And then the last thing I just wanted to touch on is reasonable compensation. This is something we spend quite a bit of time helping clients with. And there's really two categories. There's pre-CIC reasonable compensation and post-CIC reasonable compensation. To take those in reverse order, the post-CIC can be really helpful in the situation. And it's probably best explained using an example. The one we see most often is non-competition agreements. A lot of times the way severance or CIC plans are structured is that the compliance with a non-compete agreement is actually how you can keep your severance. So 280G acknowledges that you can, some certain payments can be deemed consideration for actually complying with that non-compete agreement, and therefore can be carved out of the 280G calculations because it's really for that separate agreement. So this can be very helpful, and this is how we see, a lot of individuals avoid the 20% excise tax if they are agreeing to these stringent requirements. But just it's really important to be sure that these are legally enforceable. So working with the attorneys around these to be sure that they would stand up to scrutiny. But then also it's super important to get a formal valuation done by a valuation expert on what is reasonable to pay somebody for agreeing to comply with these arrangements. And it's also important just from a compensation perspective, is that a reasonable amount for that individual to receive as well? So there's several aspects of that, and it can get quite complicated, but it's definitely an exercise that's worth at least checking to see if it might work for your company. And then just quickly for the pre-CIC, usually don't get quite as much bang for our buck here, but can still be a very useful tool, which is looking and seeing if certain amounts that the executives are receiving really were already effectively earned based on performance as well as the time that they worked for these arrangements. So the easiest example is, it's very common now to have long-term incentive awards like PSUs, for example, that cover multiple years, and maybe you're 2 years into the 3-year performance period, as an example, there's ways to look at where you're at on performance, and maybe a piece of that could be excluded as effectively reasonable comp for services already rendered. But again, you have to do quite a bit of evaluation on that and prove out performance to be sure that that actually works. So with that, I think that's all we have on Section 280G. So I think that will take us to our next polling question.
Yeah, and so to lead us into the next section, it's due to ESG factors, my company has recently made changes to our exec comp plans, qualified plans, both, neither, or not applicable. Again, if you're a provider or practitioner, we understand you're not applicable. Again, there are no right answers. Just to touch on a few things that were mentioned, as Allison noted, if you'd like a copy of the report, our contact information is at the end of the slide deck. Feel free to send us an email, and when it is released, we'll happily send you a copy. Also, just to note, we have gotten some questions. We're trying to answer them as part of the presentation. If we don't get to your questions and you'd like to speak to us afterwards, definitely feel free to reach out. We're happy to do so. Just to note before we get into the details of ESG and exec comp and qualified plans, as I mentioned at the introduction, ESG is a hot topic, right? We've all heard, oh, well, we want to make sure that we're paying our fair share. We want to make sure that we're doing right for both the economy as well as the world, as well as the climate. And so really, it's been an interesting movement because people have been trying to figure out what is ESG, how do we measure ESG? This is something that our firm has spent a lot of time working on. And so we have a lot of questions and discussions with companies regarding the tax side of things. And now, on this part of this presentation, we're going to talk about some of the comp and benefit side. So I guess, Allison, if you want to discuss ESG and comp considerations, that would be great.
Absolutely. And I'll hit this pretty quick because I want to be sure Patrick has enough time on the qualified plan side. But two things that we're getting lots of questions on from clients is, how do we tie compensation to these important ESG initiatives? The thought being that we want to put our money where our mouth is and tie people's compensation to really making progress in these areas. But it's, easier said than done. There's a lot of things to think about as you implement ESG within your incentive programs. I think probably the biggest thing is just when you're starting off on this, really think about your why. And how does that fit overall with the strategic goals and objectives of the company, and not just doing it because it's what everybody else is doing. It's really important to think about what makes sense specifically for your company. Some of the questions we get the most are, what are the right metrics to use? And I will say that it's so dependent on your industry. Using the example, if you've got an oil and gas company versus a software company, the way that they will implement ESG metrics will be night and day different, simply due to just the nature of their business. But common ones that we see in the environmental bucket are greenhouse gas emissions, land protection, water use, things like that. Social metrics, one that I just wanted to highlight is we've definitely seen an uptick in diversity initiatives, and that being one of the criteria for incentive programs as well, as making progress around diversity. And then safety has always been one that's been pretty common in that bucket in certain industries, but still a common metric to use in incentive plans. And then under governance, mostly this is kind of in the flavor of risk management or different types of compliance initiatives. But it's important to think about what's the right metric, how many metrics do we use? Does it make sense to actually use a couple of different metrics? And then how much do we need to weight them relative to other metrics within our plan? Most of the time, some of our internal research shows that it's more, in the 10 to 20% range of weighting for these, but it definitely does vary depending on industry and what the metric is itself. The other thing I just wanted to quickly highlight in this area is where to incorporate those metrics. By far and large, most of the time, this is going to be incorporated into a short-term incentive plan. And I think that's just because, wanted to ensure that companies are thinking about this and working to it working towards it right now. So putting in the annual plan helps companies focus on it right now. But we are seeing more companies explore including it in their long-term incentive plans, especially for certain metrics, say in the environmental bucket, because the change that's needed in that area really can't happen overnight. It's going to require years and years of investment before results may be realized in that. So we're seeing more and more where companies are exploring including a metric in their long-term incentives, but still very much a minority practice within LTI programs. Now, quickly, pay equity. There's a couple of components on this, but something that's very focused on recently. So gender and racial pay equity, ensuring that we're paying employees equally for comparable work, has definitely been a focus as part of ESG, as well as internal pay equity. I think there's been a lot of focus on
Allison, I think we lost your audio. No, I think we still lost it, but I guess while we're trying to regain it, Patrick, why don't we just go ahead with the ESG and qualified retirement plans?
Yep. Thanks, Kevin. So ESG and qualified retirement plans is fundamentally different than the ESG and compensation plans that Allison was just talking about. And the reason is because when we're looking at ESG and the compensation plans, it's looking at how organizations can get metrics in those compensation plans, whether it be STI or LTI or pay equity, such that you are showing that you do have ESG metrics. On the retirement plan side, it's almost flipped on its head, because what we're looking at there is to what extent can fiduciaries and retirement plans who are governed by ERISA and those fiduciary standards take into account ESG metrics. So as the slide here says, the Biden administration released a proposed rule on October 13th. Unfortunately, this isn't our first go around with a proposed rule. Back in 2015, the Obama administration released a similar rule about ESG and noted that plans and fiduciaries were not precluded from considering investments selected for the economic benefits they create and from their investment return to the employee benefit plan. So in other words, the Obama administration said, yes, you can look at ESG when you're selecting investments. And that is can be fiduciarily prudent. In October of 2020, we were under a different presidential administration, this time a Republican administration, and the Trump administration DOL released their rule, which stated that plan fiduciaries may not consider non-monetary factors when selecting investments for a qualified plan under ERISA. So the DOL under President Trump said, you can't look at non-monetary factors. The one exception to that would be that if it is using a non-monetary factor to break a tie between two investment alternatives that are equivalent based on the monetary factors. So the Trump administration came in and said, no, you cannot look at ESG except to break ties. Then on October 13th, so just a couple of weeks ago, the Biden administration came back and said under their proposal, the DOL made it clear that ESG factors are materially financial factors that fiduciaries can and should consider in their roles as fiduciaries to plan participants. So now we're back to, yes, you should consider ESG. Because it was released on October 13th, we're still currently in the 60-day comment period from the public, and the final rule will be released, presumably, based on the comments from the public. Where we end up on the final rule is probably anyone's guess, but what I would say is ESG will be a factor. The big issue, though, will be whether fiduciaries are required to consider it or whether they're allowed to consider it. So again, not sure where it's going to end up. To Kevin's point earlier about things in DC, they have a tendency to shift around throughout the process. But just know, one of the big things I've noted is that President Biden put this as something that he's doing in the first year of his presidency, whereas President Obama and President Trump both addressed it at the tail end of their presidency. So in all likelihood, we will get a rule passed, a final rule passed. It's just what that rule is.
And just to quickly note, right, that this is also consistent with a lot of other agencies. You can see the SEC and what the SEC is doing with regards to ESG. So this is really part of a much broader, as you noted, Patrick, an administration's movement towards taking into account ESG. And so that's why we're collectively all saying, we're seeing companies focus on ESG, we're seeing the administration focus on it, and it really probably is a question of, can they or do they have to, as opposed to, it might be, dropped.
Exactly, Kevin. It's again, first year of his presidency. In all likelihood, this thing is going to get passed. We'll see what happens down the road, but hopefully we'll get at least a little bit of clarity here. So now shifting gears. In July of this year, we got an update to the Employee Plans Compliance Resolution System, or EPCRS. EPCRS is the system or the revenue procedure published by the IRS that allows for qualified plan sponsors to undertake specific actions to correct failures that have occurred in the administration of their qualified retirement plans in order to retain or preserve the tax deferred status of those plans. In other words, if you have a 401k plan and you have a failure in the administration of that 401k plan, technically it could become disqualified and all the amounts under the 401k plan could become taxable, currently taxable. So because of how draconian a result that is, the IRS, through multiple iterations, has developed the EPCRS to allow plan sponsors to correct those failures and preserve the taxable status. 2021-30 is our latest iteration, and it makes a few different changes to EPCRS. First, EPCRS is expanded in terms of how you correct errors in which employees or former employees receive amounts in excess to those to which they were entitled. So if I was owed $100 under my 401k plan, but I got paid $1,000, that's an overpayment. Under the new version of EPCRS, the IRS has provided more correction methodologies for recouping that money. Since I got my $1,000, I got $900 too much, and those $900 should go back to the plan. What the IRS has always said is that plan sponsors are responsible for going to try to get that money back. And if they can't get that $900 back from me, the plan sponsor has to contribute the $900 out of its own funds to the plan. Now, in terms of defined benefit plans, that's kind of a strange proposition because my $900 that I got paid would just go to an overall pool. And so that pool is used to pay all of the liabilities of the retirement plan. What the new guidance says is that if the defined benefit plan is fully funded, there's no reason to have to pay back the plan for the overpayments. It already has enough to satisfy all the liabilities. Why didn't we need to pay it back? Which makes sense. Additionally, the new guidance said that if there is a de minimis amount, it used to be $100. If I was overpaid by $100 or less, the plan sponsor didn't have to take any corrective action. Under the new guidance, that de minimis amount is raised from $100 to $250. So that's good guidance for plan sponsors. I have a lot of clients that have to deal with this, and they hate having to go back and try to get money from former participants and update tax filings. So anything they can do to avoid that is beneficial to them. Next is that 2021-30 eliminated the anonymous VCP. So Voluntary Correction Program, or VCP, is a program in which a plan sponsor submits to the IRS information about the failure and a proposed correction methodology, and the IRS signs off on that methodology such that the plan sponsor has protection if they're ever audited. In the past and currently, we have what's called an anonymous VCP. So a plan sponsor can send out or submit a BCP without any identifying information and only identify themselves once the proposed correction methodology has been agreed upon between the plan sponsor and the IRS. The IRS has disallowed or prohibited that, discontinued that anonymous BCP effective January 1st, 2022. Starting in 2022, a practitioner essentially can request a pre-submission conference where they talk through the issues with the IRS, but they can't submit an anonymous BCP. I don't see this one as too big a deal. I have very few clients that use the anonymous BCP, just because if you're going to the IRS, in all likelihood, you're going to negotiate and come to an agreement. So it just doesn't provide the protection that it's necessarily worth. Self-correction. The self-correction program is like the VCP, except that the self-correction program doesn't include any submission to the IRS. The plan sponsor just documents their file about what actions they took, and that's it. It used to be that a plan sponsor had until the end of the second plan year, following the year in which a failure occurred, to correct significant failures, but under 2021-30, it's now the end of the third year. So it adds one more year to it. And also under SCP, there was an expansion of the retroactive amendments that are allowed. So it used to be that you could retroactively amend your plan to conform operations with plan terms, but only if you satisfied two kind of general criteria. One, you're increasing benefits, and two, the increase applied to all participants. Under 21-30, we now only have the first requirement. So we now only have to increase benefits, but it doesn't have to apply to everybody. And then finally, this one was probably the least surprising. For certain auto-enroll failures in 401k plans, there was a correction methodology that was very beneficial to plan sponsors that sunsetted on 12/31/2020. That being said, the 21-30 extended that sunset until 12/31/2023. So we have some beneficial guidance there.
Great. And in the interest of time, we're going to launch the next polling question and then go back to allowing Patrick to inform us on what he's seeing on the audit focuses. But again, as we mentioned, if you'd like us to schedule a call with us to discuss exec comp, qualified plans, both, not applicable or you're not interested, please just fill in the survey. Again, filling it in enables you to get CPE. Patrick, while they're going and filling out the survey, if you can sort of highlight what you're seeing from an IRS and DOL audit focus, that would be great.
Yeah. What I know we only have a few minutes. What I would want to focus on, if you look at the slide about the audit focuses, we have 4 bullets, one about lost participants, one about RMDs, one about participant loans, and one about a plan's definition of compensation. The biggest focus we've seen recently is that first bullet, locating lost participants and ensuring that they receive the benefits to which they are entitled. We are seeing that the DOL and IRS are really taking a look at making sure employees or former employees get paid out the amounts that they have accrued in either a defined contribution plan or defined benefit qualified plan. Just because they see this as a way to help employees who may be in retirement. And they think that plan sponsors have a fiduciary responsibility to keep up with individuals who have money in their plan. If I have $10,000 in a plan and I'm struggling to make ends meet, that can make a big difference in my lifestyle. So what we're seeing is that the IRS and DOL are really, really focusing on making sure that the plan sponsors have good procedures in place to periodically search for lost participants, and they're reaching out to them periodically to make sure employees know that they have money in a certain plan. We've unfortunately had the experience that in some cases, DOL audits will drag on for years while the plan sponsor is trying to locate some of these lost participants. And it might be that they terminated 30 years ago. So they quit in the 90s, and the plan sponsor having to try to track these people down, or their beneficiaries. So what I would say to plan sponsors is make sure that you have really good processes for lost participants, and that you are keeping up when people move addresses, or you're doing death searches to make sure participants haven't died and now amounts are going to their beneficiaries. These other 3 bullets, RMDs, that we've seen that for the last several years, that's a priority. Participant loans comply, that's something else. The IRS did announce that they thought that they were going to look at plans with unusually high loan balances, so make sure to keep an eye on that. And then definition of compensation is always one of the #1 errors in qualified plans.
Great, thanks so much. And it's really interesting when you look at this, and especially when you're starting to think about lost participants in COVID times, it becomes even more geographically difficult, because it's no longer just a case of, oh, these employees were in this location, I can easily track them down. We've seen this in many other exec comp areas and just benefit areas where you're like, okay, well, what is the location of the person? This person used to be here, but now they're in this jurisdiction, and who knows where they are? And that goes into a whole host of other fun opportunities like state withholding and the like. And so it's really becoming a more challenging environment. And as Patrick, as you said, the fact that these audits can drag on for many years, you can only imagine what happens, several years from now, post-COVID, when the workforce is scattered and who really knows where everyone is.
Exactly. And those dragging on for years is a drain on internal resources as well. You have a job to do on a day-to-day basis. You don't want to deal with a DOL audit.
Great. So with that, I think we're going to turn it over to Kevin DeYoung to help show everyone how Answer Connect can help give them some resources to further look into some of the topics we discussed today.
All right. Thank you, everyone. Sarah, have you pushed over the share to me?
Yeah, but let me try it again.
There, got it.
Okay.
All right, we just have a couple of minutes left in our hour time frame here. So just wanted to take a really quick high-level look at CCH Answer Connect, our tax research platform. As you've heard several times during this presentation, if you're looking for more information, if you want to know more, please reach out. We're going to ask the same thing here. What I really want to focus on as we built CCH Answer Connect was how content is put together. Really focusing on the presentation of information, the tax research workflow, and how CCH Answer Connect can best work within the framework of doing research and how you're accustomed to doing it. We're going to spend some time actually looking at this as though we were doing some research based on the golden parachute that we heard about from Allison in early part of the presentation. I really just want to start there. As we built CCH Answer Connect, we wanted to get rid of publications. As you can see from my home screen here, we're really focused on content. Are you looking for a tax topic? Is there a code section you're looking for? Where do you want to go? There's some other information on the legislative highlights, which, as we all know, is going to become a huge issue here in the very near future, likely, as well as some of the COVID-19 as we start to phase out beyond that and move into the legislative piece. What I'm actually going to do really quickly here is just run a search on golden parachute, as we've heard discussed here. I really want to spend a little bit of time focusing on what type of information you're going to be able to see here. There we go. Sorry, my internet connection is a little bit slow today. What we're now seeing as we log into CCH Answer Connect is our content related to our federal topic, as I've done searching here. We also break the content down into state, international, as well as some of our specialty areas from this piece. But what I want to talk about initially is jumping into that explanation. We talked about the calculation of the golden parachute payments. I'm going to go into the CCH explanation as it relates to that. What we've done here is now gathered all the content related to golden parachutes as it relates to 280G, as Allison had mentioned, all the subclassifications, all the categories that you would have looking for information for. But what I really want to spend a couple of moments focusing on here is the way we structured the information. We've brought everything related to 280G now into a single screen view. So if you begin your research in the code, you have the ability to go into the IRC section, read that in its entirety. You can then scroll over into the next tab and take a look at the regulations related to 280G. What is the interpretive guidance from the IRS going to be? We were already in the explanation tab. You have the ability to take a look at what CCH has put together for you. We can scroll further down and we can actually expand out our golden parachute explanations to dive deeper into specific areas within this topic that may be on point or relevant to our tax research process. From here, we can then move into our cases, administrative guidance, rulings, annotations, everything that's been out there that's legislated on this piece. We do have access to our forms and instructions. What I also want to bring to your point here is tools. Because what we heard as we developed CCH Answer Connect was the need to be able to communicate findings, whether it's to a client or whether it's within the corporate tax department, what the outcome was. Our editorial team has now taken the tools and brought them into the research workflow. So you have that information at your fingertips as part of the overall process. Newly added for us is an additional tab, our More tab. What we've done here now is actually expanded our content into additional areas within CCH offering. Our tax prep partner, that is our tool that we use that ties into our compliance pieces, which is more compliance based on how you would handle this. We've also then brought in some of our great treatise content. We heard mention about this topic in mergers and acquisitions. We're now linking you directly into our mergers and acquisition treatise to find out what the penalties or change of ownership as it relates to golden parachute payments are, how it can be calculated, and moving through that process. So again, this is looking at our information from a code-based structure. I'm going to jump really quickly back to my search results. I'm going to change my view a little bit here, and I'm going to get into my topics. Where we differentiate between our explanations, our topics, is the explanations are very much geared towards the specific code section and walks you through it in that order. But what we've actually done here with our topic pages is given you a larger scope view of the overall concept as a whole and allows the researcher to digest and become better informed overall on what's out here and what's available. So these are our topic pages. You can see it's actually dropped me, I'm in my limitations on compensation deduction topic page, and it's dropped me directly into my golden parachute section where we're going to give you some additional discussion. We heard some talking about covered employees. We cover that for you. Examples. I'm going to use some of my navigation screens here so we don't make everybody dizzy. We talk about compensation as it relates to it. But what we've done to take this a level further now is brought in recommended topics. Is there other information you need to be aware of? We've also brought in then all code sections you maybe need to be aware of. Some may know that 280G is the golden parachute code section. But for those that are less versed in research, would start in this kind of explanation, we're going to drive you to that content. The user can simply click on this link. It will then take them to that 360 view, if you will, of all the topic and all the tabs and all the content that we had available here. We talked about some additional legislation that's taking place that is also available. So that was a really quick overview in terms of how to maneuver around CCH Answer Connect. Want to take one step back, and I'm going to go jump out to Google. Because one of the things as we developed CCH Answer Connect is we realized and we heard over and over again that Google is becoming a far more utilized tax research tool. We then wanted to integrate exactly what you were doing in research workflows and put our content in front of you. So I've already run a search here for golden parachute, and as part of our subscription to CCH Answer Connect, we actually now include our search results directly within that Google search or Yahoo search, whatever search engine you're using. You'll notice my first explanation is that explanation that I jumped into originally when I was in CCH Answer Connect. But we really wanted to take this one step further and really wanted to integrate our content into any document available on the web. We know that we are coming up on some pretty significant legislations in the coming weeks and months. So the information that we're seeing on the web may or may no longer be applicable law. And what is your risk? What is your exposure if you're using law that has been subsequently changed and you're not aware of that? I'm going to have a little bit of fun here, and we're going to go into Wikipedia because every good tax researcher is going to start in Wikipedia. and I've gone through and I've taken a look at this document and it seems to be on point, but now I need to verify that. If I simply come in and highlight the code section 280G as made reference here, and I search within the CCH browser search, I am now initiating the search back in a trusted known source related to 280G golden parachute payments. And I'm back within that 360 tabular view to verify whether or not the document that I've just read on the web is still applicable in current law. Again, would love to take a little bit more time with you to dive into this deeper. We've hit the top of the hour, so Sarah, I'm going to pass it back to you for our final polling question.
Great. Thank you, Kevin. And to all of our speakers, thank you. And for everyone who's attended for joining today. We have this one last polling question. Would you like a more in-depth demo or further details on the resources and tools available in CCH Answer Connect? If you could please select one so that this will count towards your CPE. That you will be receiving an email between 2 to 4 business days, letting you know how to access that certificate. And with that, I will sign off for today. Thank you, everyone.